Hello there. Well, markets remain very volatile, but they have largely recovered from the lows we saw just after the Russian invasion of Ukraine. In fact, most markets are actually now up since the day just prior to the invasion. Having said that though, lots of asset classes and markets are actually down so far this year. We're going to put up on screen a table which shows a selection of asset classes and indices and what returns they've had since the beginning of 2022. And you can see that with the exception of the FTSE 100, which has gone up, driven by its large exposure to oil and gas and mining stocks, everything else has fallen, and in some cases fallen really quite significantly. In fact, I think the standout for me on that table there is gilts, which have lost over 9% so far this year, which I think is absolutely astonishing for something that is supposed to be a risk-free asset. So markets have stopped worrying quite so much about the Ukraine situation directly, but some of the indirect concerns remain. What we've been worried about for a little while about the rising cost of living, higher levels of inflation, and how central banks are going to react to that. So central banks are putting up interest rates, and markets now believe they're going to put up interest rates much, much more quickly than they thought a few months ago. And that's one of the reasons why we're seeing bonds in particular sell off very sharply and why gilts are down so far this year. So what do we do about it? Well, you know, as usual, we like to look at valuations. Gilts, for example, being now down 9%, have gone from a yield of less than 1% at the start of the year to getting close to 2%. That's not particularly attractive, but it starts to look better value than we've seen previously. So we have now moved from a position where we had been, had very little exposure to gilts and other government bonds, and we have now started to add to those bonds. Because we know that what tends to happen is if we see a downturn in the economy, those bonds tend to rally. And talking of downturns, one thing we have seen from the bond market is the dreaded so-called inverted yield curve. And it sounds pretty technical, but usually longer dated bonds yield more than shorter dated bonds. People want a premium for tying their money up for longer periods. But occasionally that relationship breaks down, and shorter dated bonds yield more than longer dated bonds. When that happens, we call it an inverted yield curve, and historically it's been a pretty good predictor of recessions. So bond markets, in theory, are signalling concerns that we could see a recession. Now, we're not sure that's going to happen. We hope it can be avoided, but certainly what markets are trying to tell us is that whilst we think central banks will put up rates this year, they may then have to cut them again. In fact, we think that perhaps central banks won't be able to put up rates as much as markets have already priced in. So we have a lot of uncertainty out there. What's going on in the bond market has a knock-on effect to equity markets, and that's why you've seen some of the indices in that table down quite so much so far this year. But that volatility has also presented opportunities, and after the Russian invasion, we were able to top up equities and other assets that we like infrastructure and property, at relative lows. So we're cautiously optimistic looking forward, but we do have to acknowledge that there are lots of risks out there and we need to be very vigilant. Thanks very much.